Hello, and welcome to Let's Chat with Jen and Angie. I'm Angie.
And I'm Jen.
And together we are Heart and Home Legacy Group with Edina Realty. Today we are very excited to have Sandra Dezell with us with Prosperity Mortgage. Welcome, Sandra.
Welcome. Thank you for having me, and I'm excited to talk about the mortgage process with
Yay,
you today.
awesome. So are we.
Well, Sandra has been in this industry for many years, and we have worked with her for many years. We've had many successful transactions with Sandra. And Sandra is here today to share with us the application process and all the different verbiage that comes along with that process. So thank you, Sandra.
You're welcome, and I hope after today it doesn't seem as scary to you and you're ready to get started.
Yes, and that's one of the things. So Jen and I were talking about, what is like the scariest thing for everybody in the process of purchasing is the application process, because I think people don't realize that it's not scary, and it's not at all. So we're going to delve into from application process to all of the fun things that come along with that.
So let's start from the beginning. When you get a new buyer, and they call you or they go onto the website, walk us through what an application process looks like. What kind of questions they might come across. How do they get started? Kind of just talk us through that.
Sure, absolutely. So most clients today want to do it online, but we can definitely meet in person or do it over the phone. So whatever works best for the client. But the online process and myself, what we're going to do is we're going to ask about basically three things. We're going to ask about their income, and we need to go back 2 years to see what their income history, where they've worked in the last 2 years. We're going to ask them about what they have for down payment and closing costs. What have they saved? What do they want to use towards their down payment and closing costs? We're also going to ask them where they've lived for the last 2 years. So we need an address history for 2 years. From there can be many questions that either the buyer has or myself has, but that is our starting point, and we will go from there.
So it sounds to me like everything at that first step are all things that you would just know. Your social security number, your job, where you've been the last 2 years, and the documentation needed for that would be with like your tax documents.
Correct.
So it's not like, because I think people feel like, oh, then I'm gonna have to hunt this down and that down. It's not that daunting. You probably already have it in your computer or in your desk. You just need to send it over.
Right.
And you hit a button to apply. So you
Correct.
really can do it from your couch at home, hit apply.
Yep.
Okay.
And there is, for our online process, it's a question and answer. So it's not like you fill in the blank. It will ask you questions and you respond. It also has a way to connect maybe your income information. But I always tell people we love the number 2. So we go back 2 years for income, 2 years for residency, and we go back 2 months for bank statements.
Okay.
So that is kind of the simple starting point from there. Of course, I may have questions, and you as a buyer may have questions as well, but that is our starting point.
Well, that's easy. So they push the button and the application is sent, and now you're going to do your research, and then what?
So I'm going to, once they push the application and they're finished, I'm going to take it from there. First thing I'm going to do, when they've applied on our online application, it's going to ask them if I have their permission to pull their credit. So that will be in there. I will pull the credit, and that will give me the credit score that I need that will help determine what kind of program we can look at.
So, maybe we'll stop there for a second.
Mm-hmm.
A lot of our clients will stop Angie and I, and they say, well, I don't have great credit, or I have great credit, or what is credit? I mean, so can you talk a little bit about credit? What
Well,
does
and then
that
you
look
hear
like?
the words, the one thing they always ask us is, what's Freddie Mac, Fannie Mae? Like, there's Freddie Mac, there's Fannie Mae, there's all these different numbers, and kind of what do those numbers mean?
Okay.
You don't have to delve super deep into it, but it's just a general question that we do get a lot.
Mm-hmm.
Yep. So you hear Fannie Mae, Freddie Mac, FHA. So first of all, going back to credit, that kind of drives which direction we can go. Fannie Mae and Freddie Mac is for your conventional financing, and that is they're the investors for that type of financing. FHA is for a government-backed loan. and they will allow for a little bit lower credit scores.
Okay.
You don't have to be a first-time home buyer, but if you have credit challenges in the past, they have shorter wait times for that. They allow a little bit lower credit score as well. They're not sensitive, interest rate sensitive so much as a conventional product.
What is a low credit score?
Well, the very minimum you're going to be able to do financing is 580.
Okay.
Which sounds wonderful. Now, when we do that, there's going to be extra criteria that we're going to ask for. We're going to ask for extra savings on the side. We're going to ask for stronger work history, etc. So the goal is you want to get to 640.
Okay.
So FHA, once you get that, all extra criteria are removed from that. So the goal is to be 640.
And truthfully too, the better the credit score, the lower the interest rate?
Yes, it is interest rate sensitive. So your interest rate is dependent on your credit score. More so for conventional than it is for FHA.
Okay.
So we keep hearing these words. So FHA. So once the application process is done and you've gone through, you know what their credit score is, you know what their debt to income ratio is, you now know what their work history is. You've talked about savings and whatnot. And so now you're going to tell them what program is going to be best for them. And that's going to fall on, you had said the letters FHA, and then you said conventional. So let's start with the FHA one. So you're gonna tell people down a certain path. So we're gonna go FHA because of this reason. We're gonna go to conventional because of this reason. But so FHA, a lot of people think is like a first-time home buyers, but it's really a federal housing associate.
Correct.
So I want to talk more about FHA and so let's kind of start there. So FHA is not just for first-time home buyers. FHA is for everybody. So what does the FHA, what is that program?
Yeah, so that is, and I wanted to let you know too, when I have your credit score and your income, we run it through what's called a desktop underwriter. So the underwriter, FHA, actually puts guidelines within the underwriting process where we hit a button and it comes back either approved or not approved, which is not the word we want to hear. Same with conventional. So let's say I have an FHA approval. Why we would go that route? It is a 3.5% down. It doesn't matter if you're a first-time home buyer or a repeat buyer. So it's a 3.5% down. If you've had challenges in the past, like bankruptcy, foreclosures as well, they have a shorter wait time than a conventional loan will. So for that reason, you may want to go FHA as that.
So FHA has a little bit looser guidelines in regards to past history things.
Past credit history.
Okay.
Yep. As well, FHA, regardless of how much you want to put down, I mean, you can put 20% down on an FHA, you're going to have mortgage insurance with that product as well.
For the life of the loan?
For the life of the loan,
And
correct.
what percentage is mortgage insurance?
So they break it up in two parts. What they do is they finance a big portion of it, which is usually about 1.75%. If you put more down, these numbers might lower a little bit. And then so our more recent changes, they went 0.5% for monthly insurance. So you've got it financed into your mortgage. And what that means is if your mortgage, for example, is $250,000, they'll finance it where now your mortgage is maybe $255,000. So it's going to add it to the mortgage, and that will be spread over 30 years. Then you have a monthly mortgage insurance as well. So because of the mortgage insurance, we tend to see lower interest rates for FHA because of the mortgage insurance that's part of that loan.
Okay.
So why we have experts who work in this industry is you will sit down and decide what is the best loan for the client, for the buyer.
Correct.
So with FHA, you have right now lower interest rates.
Correct.
But you will have the mortgage insurance, as you have mentioned.
Right.
Okay. So that's FHA. Now we've got conventional. So conventional is another. So you have FHA, you have conventional.
Correct.
what is conventional and what does that mean? Conventional does not have to, if they put 20% down, they do not have mortgage insurance.
That is correct. So we do, once you have 20% down, there is no mortgage insurance. Now, as far as credit scores, they want to see 680 and higher. Does that mean you have to have 680? It means that what we tend to see when we run it through our desktop underwriter, whether we get an approval on that as well. They may ask for reserves as well. What are reserves? These are savings that you want to have after closing. We don't see that very often, but we could see that on a conventional. If you have mortgage, one of the biggest myths for conventional is buyers think they have to have 20% down.
Right.
They don't. And as a matter of fact, many of my buyers have 3% down. If you're a first-time home buyer, you're allowed to have 3% down.
Go conventional.
And go conventional, correct.
But pay mortgage insurance.
Correct.
Mhm.
That is
Until
correct.
you hit the 20%.
Mhm.
And then with a conventional loan, you're able to drop that mortgage insurance after you've paid the mortgage down 20%.
Correct. There is already a predetermined date on your loan where that will drop off. You can request it sooner, but know that if you do nothing, there's a date in the future that it's going to drop off.
Okay.
Might be about 10 years from now, but at least at that point. And there's no upfront, there's no finance, so your mortgage is the same regardless.
Gotcha. So you don't have to refinance it or anything to get that mortgage insurance off.
No,
Gotcha.
you do not.
So for FHA, down, let's just to review these two really quick. So FHA is how much down?
Minimum 3.5%.
Okay, so we have conventionals 3.5% down.
Or higher.
Convention or higher, of
Yeah.
course. I'm just saying the minimum. So
Okay.
minimum 3.5% down payment for FHA. Conventional minimum down payment is 3% if you've never purchased a home. But if you had purchased a home, you would need to put down
5%.
5%. Okay.
Correct.
So those are two of them. Now another one.
Yeah, so this one's near and dear to me, and you are definitely my go-to for this particular one. This one is the VA loan, and this one is exclusive to any veteran that is active duty, reserve, retired. Tell us about the VA loan.
Yes, VA is fantastic. It's a fantastic product for our veterans. So if you're a veteran and you're listening, thank you for serving. The VA is one of the few products we can do 100% financing. There's a thing called Certificate of Eligibility, which we get that. We can get that for you, or you can get that on your own. And they have what's called a funding fee. We talked about mortgage insurance before. VA doesn't have mortgage insurance, but they do have a funding fee. And what is that? That is a fee that they guarantee the lender, and they add that to the mortgage so you're not paying it monthly as well. Now, if you have any kind of disability, they've really backed off on that. You can have that funding fee waived. So there's no funding fee. So you have 100% financing with no monthly mortgage insurance.
Yes. So my husband and I are vets, so I'm an expert in the vet VA loans and make sure that I keep up with that all the time. And we do a lot of vets together, so we keep up with that. One of the things that we've noticed is in this neck of the woods, a lot of people don't know that they are eligible for the VA loan. So if you are out there and you're questioning whether you are eligible, please reach out to us, because it is for any vet, anyone who is a reservist, National Guard. If you're retired, you are eligible for that VA loan. Another thing is if you are a disabled vet, there's lots of programs out there as well, just to keep on the homeowners, like for, say, your taxes on your home loan. So just reach out to either one of us, and we can kind of help walk you through that program.
Now, another program that we want to talk about that is specific to certain areas is rural development.
Correct. USDA Rural Development.
Yep, USDA program. It is a rural development program. Can you tell us a little bit about what that looks like?
Yes, absolutely. So it is the other zero down program. So the difference between USDA and VA is USDA is property specific. It has to be in a designated rural development area. Also, there are income limits to that as well. They're pretty generous with that, and it does depend on household size as well. But again, there is a guaranteed funding fee, much like VA, but they also have a monthly, not mortgage insurance, but they call it a guarantee fee. So but it's less than mortgage insurance. And the interest rates are pretty competitive as well. So the two things you need to know what that is, the property is, it's property specific in a certain area, and you have to be within a certain income limit of, for example, in Sherburne County, where it's about $140,000 for a 2-household person. So,
and below?
And below,
okay,
correct.
Okay. Which, I mean, that's
pretty generous.
That's very generous.
Correct.
That's wonderful. And then when you had mentioned that it's house specific or property specific, rural development only covers certain areas. So it's not available in all of Sherburne County, but there are specific areas within that do cover rural development. And that is something that if you are interested in, Sandra can connect you with that. And then she would let Jen and I know that you are qualified for rural development. And so we know the specific areas in which we need to focus their home search on. And just like it sounds rural, it's rural.
Yeah.
So you're not going to get city life. You're going to get rural
where
living.
We live here, big
where we live here. Yeah.
Mm-hmm.
We're not out in the middle of nowhere. That's not what those properties are.
Yeah.
It's just specific to a specific area. So wanted to make sure we touch on that.
Last thing that we kind of want to touch base with is the down payment assistance programs, or first-time home buyer programs. I know that you dive into those quite a bit. What programs are out there right now for people that would be interested in maybe buying a house, needing help? What can they? What's out there?
Well, the best one is Minnesota Housing. If you've heard of Minnesota Housing Finance Agency, they're statewide. So it's within the state, and they have 2 types of down payment assistance. What they do is if your income is a certain level or below, you're eligible for a 0 interest second loan. Isn't that great?
That is
zero
amazing.
Zero interest.
So they basically are taking, so you're doing like a first and a second mortgage,
Sure.
and that second mortgage is a 0 interest mortgage.
For the life of the loan.
For the life of the loan. So you're not paying it back until you sell the home, because the hope is that A, you will pay your first mortgage down, correct? So that will start decreasing. And B, your home will increase in value.
Mm-hmm.
So when you sell the home, you will have the equity to pay that off. So that's eligible. Now they have come down a little bit in income limits for that. But for that income and below, you can get that second mortgage, and it can cover down payment, it can cover closing costs, and what we call prepaid expenses for the purpose of today, all of closing costs. So that what they do require is $1,000 of your own savings invested into the transaction. What that means is it cannot come from gift funds, it cannot come from another loan, it has to be money that you saved. That's their minimum investment. You obviously can put more into the transaction, but they require just $1,000 being a minimum investment.
Okay.
And what is that loan up to? What can they borrow up to? Is it just depending on the house price?
$14,000.
14.
They have come down a little bit on that.
Okay.
There is another one for those that don't meet that income limit and go up to. I apologize for the delay. It just was changed on March 1st. Up to maybe approximately $135,000. I'll verify that.
Sure.
You could do a monthly mortgage insurance.
Okay.
So what that is the second mortgage. So whatever interest rate you get on your first mortgage, you get on the same interest rate on the second mortgage, but it's 10 years.
Okay.
The good news with that is once that's paid off, that's your equity. You're done.
And just so everybody understands, when you have a first and a second mortgage, your first mortgage interest rate is always going to be way better than your second mortgage interest rate because it's second in line. But in this situation, it's not.
It's
so
the
that's
same.
super awesome. So
Right.
that you can pay everything down through your monthly payment faster.
Right. You are
That's
going to
awesome.
have 2 mortgage payments on a single family home. I don't know if you're going to talk about condos and townhomes. Well, you have association fees, but you will have 2 mortgage payments. You can prepay. Of course, I would pay your second one off first. So you can pay it off as fast as you want, but it's there for 10 years. And that also can be applied towards your down payment and your closing costs. And I believe they have reduced that one as well. I know it's at least 14,000. Might be a little bit higher than that, and I apologize because they just made brand new
No,
changes.
absolutely.
That's great.
And that's one thing in our industry, and that's why Sandra is so amazing, is that nothing is more consistent than change.
Yes, and I have the website that I go to
Yes.
every time. So
It's amazing.
Yep.
It's amazing. So you touched on townhomes and condominiums. So we all know when you're in a townhome or a condominium, there's going to be an association attached to that. Associations cover different things depending
Correct.
on the property, depending on the association. How does that change qualifications for people?
Well, it can, when you have an association fee, we need to count that as what we're looking for is 2 kind of ratios. We're looking for a housing ratio that has your principal and interest, taxes, insurance, any mortgage insurance, and then that plus all of their debt is the other ratio we're looking at. So when you have a townhome, now we have to factor in that association fee as well. So that can be all over, as you know, when you show properties. That can go anywhere from 150 I've seen up to 350, for example. So now we have to factor that in. So a lot of times what that does is you may qualify for a certain amount on a single family home, but we may have to reduce that when you're looking at townhomes or condominiums.
Okay.
Depending on where
Right.
you're looking, sure.
Correct. And there is a different type of insurance with that. The only difference I'm going to talk about today is if it's classified as a condominium, we do have to have the property approved as well. A townhome truly isn't a lot block. You own the dirt your home is sitting on, and we treat it very much like a single family home.
Mm-hmm.
Where a condominium, we have to approve the association as well.
Mhm.
So there's a few extra steps with that.
Okay.
And when you are looking at the association, are you looking at their books? What's kind of your main focus for an association to qualify?
Yes, we're looking at their books, their strength, what they have in reserve. The big thing is what they have in reserves when there's repairs that needs to be done. Is the association strong enough to cover those repairs without having to raise your association fees?
And so you're looking out for the buyer too,
Correct.
because, and that is part of that condominium process. We don't
Right.
get it as much out in our area, but we also work in Minneapolis, St. Paul area and help people with condos too. And so it's definitely a different market and a different world.
Yep, and
It's fun.
there's some they look like townhomes, but they are actually classified as a condominium. And may I back up? We talked about FHA versus conventional and even VA. For FHA, it's the association has to get their FHA approval. So the condominium has to be FHA approved if you want to do any type of FHA financing. For conventional, it's a one time per each project. We do approval based on that. And VA has their own condominium approval, and it's almost follows FHA, but with the one criteria that they have to be allowed to let the veteran sublet if they go on leave of any. If they can't do that, then VA will not finance on there.
Sure.
Interesting.
Well, isn't that
Yeah.
interesting?
So these are things we know behind the scenes because we don't
Oh.
expect you to know these,
Yeah.
but these are things that we research. And again, we start at the bottom and kind of grow depending on what your financing needs are.
Awesome. So now we're done with that. We're approved.
Right. We know what
We're
kind
all
of thing.
approved.
Yep.
Sandra's looked over everything and she says, "Congratulations, you're approved for $400,000, and it looks like the best that's going to work with where we're at is going to be this program, yada yada."
Right.
And then they're going to come to Jen and I, and they're going to show us their pre-approval letter that everybody's so proud of because they
Right.
should be. That was an awesome accomplishment.
Mhm.
And then we're going to start looking. And that pre-approval letter also tells Jen and I if it's obviously if it's conventional, it's something. If it's VA, it's FHA. VA, FHA, we've talked about in previous podcasts. There are certain things in houses that we need to look for. Rural development, same thing. They're particular, like FHA, with not no chipping paint, no
outbuildings.
No outbuildings, things like that. So it helps Jen and I then to know how, when we're sitting down with you as a buyer, getting ready to start looking at homes, how to focus our search and to really talk about all of those things with you.
Mm-hmm.
And then at that point, we work with Sandra and you as a buyer to find you a home,
Mm-hmm.
run different scenarios by Sandra based on where the numbers are for the house, and we put an offer in and we win, and you get a home.
You get a home and you start the financing.
Yeah.
Now, can I just say, during the pre-approval process, not only am I pre-approving you for a loan, we're also going to find your comfort level, because I may pre-approve you for $400,000, but when I explain how the payment is done, you say, well, that's not my budget is X. I want to keep my certain payment at maybe $2,500 or $2,800.
Mm-hmm.
So now we're going to find out what kind of a loan that looks like, what kind of a purchase that looks like.
Yes.
And what kind of down payment that looks like as well. So not only does the pre-approval process help us to make sure we're pre-approved and ready to purchase a home, but we also want to find out what your budget is as well.
Mm-hmm.
Yeah.
Yeah. And we like to keep it real. There's going to be times when you may not be ready to purchase a house. We may not be quite to that credit line that you want to be at, or we may not quite be to the pre-approval of the $400,000. You may not quite be there. One thing that the three of us at this table will guarantee you is we don't just leave you and say, okay, well, sorry, you're not quite ready for that. We set you up for the next step. So what does that look like? So how do we get your credit where you need to be so that we are ready in 6 months, in 3 months, in a year? We have plenty of clients that we have been working with for 2 years who we put them in their forever home, their dream home, their next home, their first home. You don't just stop. We don't just start the process and then
Boop, it doesn't work.
Bye.
Yeah.
See you later. That's not what this group is about. That's partly why our name says heart in it, because it is personal to us. So,
and so don't be the whole, this, hopefully everybody sees this as a wonderful educational opportunity. Yeah. It's not a scary process. Yeah. You have to look at the pre-approval process as your opportunity to learn where you're at.
Yep.
And if you're not at the place that you want to be, it's an opportunity for you to learn what needs to be done to get you to that place.
Yeah,
so it's not scary. It's not bad. You will probably, how many times have we had buyers that are thinking, I'm never going to get approved? This is and then they call and they're like, I just got approved. Yeah. Well, I told you that you were going to be just fine, and it's not scary. So, we just want to assure everybody and help educate people,
right?
And help them to know that you're in good hands. Yep. This is what it looks like, and don't be afraid. Right? Yep. Don't be afraid.
And we are going to, if things are not where you need to be, I have tools in my toolbox to help how to get there, and how long will it take as well. Yeah, so absolutely. We want to work with that and get you there. And that's the best way to find out. You can look at your credit score online through your bank, Credit Karma, but until you have a lender look at that and know exactly where you're at and how to get to where you want to be, that's the best possible way to go.
Mm-hmm. Absolutely.
Yep. So rip the Band-Aid off and give us a call.
Yep. You can do it. It's not scary. We're here to help you. We will make sure to put Sandra's contact information below this video so that you can reach out to her, email her with any questions. And thank you, Sandra.
Yes,
you're
welcome. So informational.
So exciting to be here.
Well, we appreciate you all the time, and thank you for always taking great care of our clients.
Absolutely.
And us, because don't get yourself. Jen and I can be a little high maintenance. All right. Well, be sure to share this video, like this video, subscribe if subscribing is available on the social media that you are on. And thank you so much for joining us for Let's Chat today.
Bye-bye.
Bye. How was